Moving on to other stories now. Yesterday, President Moon Jae-in called for steps to slash red tape in the country's financial sector. He focused on separating commerce and banking. The debate continues on the call for this type of change for internet-only banks. Kim Hyesung provides a closer look.
The move to deregulate internet-only banks is gaining traction, pushed by not only the banking sector and the Financial Services Commission, but also President Moon Jae-in. Under the current Banking Act, non-financial business operators cannot hold more than 4% of the total number of outstanding voting stocks of a bank and 10% of its stocks. The law was introduced in 2002 to prevent financial banks from being used as companies' own private vaults, but now there is a growing call to revise the law, saying that it is holding back innovation. Due to the shared ownership limit, Kakao Bank, which was launched by a local IT giant Kakao last year, can own only 10% of the bank's shares, with the majority owned by Korea Investment Holdings. The same goes for K-Bank, the other internet-only bank in the country.
Internet-only banks are created to help individuals, small businesses, and to nurture innovation. But under the current banking structure, Korean tech giants need other shareholders' approval to raise capital and invest in new products. In other countries, there's also a separation of commerce and banking, but there are exceptions for internet-only banks. For instance, internet-only banks in Japan own 100% of their shares. Some US tech companies have internet banks as their affiliates.
It's not just Japan, the US, and Europe. China's leading tech companies, Alibaba, Tencent, Xiaomi, Baidu, all have their own internet-only banks that help them come up with new financial investment products and invest in AI and other areas. With growing calls for easing of internet-only bank regulations, it's highly likely that Korea's parliament will pass a bill on raising the share ownership for non-financial business operators from the current 4% to a range between 34% to 50%. But with opposition from civic groups, preconditions and restrictions may be included to prevent large conglomerates from owning too many shares. Kim Hyesung, Arirang News.